welcome to IIEA Insights with me, Dan O'Brien. Americans invented the multinational corporation, and US companies have been in the vanguard of the globalization process since the middle of the last century, something that has been facilitated and supported by successive US presidents until earlier this year. The Trump administration's dramatic changes in America's international economic policy reverberate around the world on a daily basis. Today, global markets moved yet again on news that a US court yesterday found that the executive had overstepped its powers when imposing most of the tariffs it announced on April 2nd. Today, we're joined by four speakers who will discuss these changes and attempt to look at how corporate America will respond to the changed political and policy environment in terms of their trade and international investment strategies. Let me quickly introduce our four speakers. Mike Beary, currently Chair of the Governing Council of University College Dublin, is a former senior executive at both Amazon and Amazon Web Services. Courtney Fingar runs Fingar Direct Investment and is still, unlike what I mistakenly wrote in the invite, senior advisor at the World Association of Investment Promotion Agencies in Geneva and content editor for FT Live. Joe Quinlan is a Wall Street veteran and a senior fellow with the Transatlantic Leadership Network. Anna Scally is an international tax partner at KPMG Ireland and is the firm's sector lead on technology, media, and telecoms. Anna, could we start with you on a topical issue? I know tariffs get most of the headlines, but tax is an important issue. Last week, the House of Representatives passed a huge tax bill. If that ends up being enacted as it's currently formulated, wondering if you have any thoughts on how it would change incentives and disincentives for US companies investing abroad or for foreign companies investing in the US from what you've seen of the bill.
Certainly. Good afternoon, Dan, and everybody. As an initial comment, I think it is worth noting that the bill, while it passed the House, it passed by a single vote. And that was after extensive lobbying, including by the President himself. So it isn't clear whether the bill will pass in its current form through the Senate. However, there is lots in the bill that we need to be mindful of. And there's a couple of things I would like to touch on that could have a significant impact on investment by US companies abroad. So firstly, the bill proposes preserving the existing low rates of tax, which were introduced under the first Trump administration, and strives to make them essentially permanent. So those low rates of tax apply to certain types of income, often referred to by their acronyms GILTI and FDII, Global Intangible Low Tax Income being GILTI and Foreign Derived Intangible Income being FDII. Essentially, those rates deliver a much lower rate of tax, probably about 13% for many corporate taxpayers that own intellectual property. Interestingly, the FDII regime rewards companies that keep their IP in the US and license them abroad. But conversely, the GILTI rate means that US multinationals are not necessarily penalized for keeping their IP outside of the US. Those rates had been due to expire at the end of this calendar year, which would have been a big deal for many corporates. But with slight modifications, they will be preserved if this bill passes. On specific incentives, there were some specific incentives that were introduced also, namely one around R&D, research and development. Costs can be expensed in full in the year they are incurred, whether or not they're capitalized for accounting purposes. That would represent a significant change in current policy if that comes to pass. And the distinction there is R&D incurred in the US would be expensable immediately, whereas R&D incurred abroad would still be capitalized and amortized. And the bill also then seeks to introduce what they call 100% bonus depreciation for certain investments, so write-offs immediately. So they're just some of the key things that the bill does to try and encourage investment in the US. It also has a second arm, which seeks to introduce some pretty targeted measures and that would impact on foreign multinationals investing in the US, where those multinationals are located in certain jurisdictions. And those jurisdictions are jurisdictions that have introduced unfair tax measures or what are perceived to be unfair tax measures. So most notably, payments leaving the US to foreign headquartered multinationals could be subject to an extra rate of tax. And that's 5% withholding tax in year 1, 10 in year 2, 15 in year 3, 20 in year 4. and it'll ratchet up for those 4 years unless something changes. And essentially, that withholding tax or additional withholding tax is targeted at payments like royalties, interest, lease payments that are made to countries, which would include Ireland, UK, all of the European nations that have implemented the OECD Pillar 2 provisions, which include an undertax profits rule. Any of those countries would be targeted by this measure. Also, countries that have introduced digital services taxes would be targeted by this measure. So very, very targeted measure targeting non-US headquartered multinationals and payments essentially leaving the US to go to countries that have introduced these rules. There's also a second provision that's there designed to target non-US multinationals. And essentially it is what might be called a super BEAT. Anybody who's familiar with BEAT, it's a base erosion and anti-abuse tax that was introduced by the Trump administration's first administration. But there'd be a super or an extra bad BEAT tax on for foreign headquartered multinationals with US subs in certain instances. And the last thing I'll just mention is a rollback on certain incentives that were introduced under the Biden administration. So many people will be well aware that there were a wide range of credits and incentives that were introduced under the Inflation Reduction Act under the Biden administration, and they were targeting investment in clean and green investments. Essentially, what this bill does is to try and curtail or abolish those investment incentives that were introduced. And doing that could have a significant impact on both US and internationally headquartered multinationals who are relying on those incentives to essentially make the financing of green tech and clean tech investments make sense. So quite a lot in the bill, Dan.
Okay, thanks. Thanks for that, Anna. Joe, can I go to you? In your recent, 22nd report on the transatlantic economy, you wrote with Dan Hamilton, the commercial relationship between the United States and Europe is by a wide margin the deepest and broadest between any two continents in history, and those ties are deepening, you wrote. How do you see tax issues affecting that particular relationship between Europe and the US?
Well, Dan, Anna did a great job laying down the specifics, and the taxes, of course, are very important to multinationals, US and European. So there's a lot of sausage making going on right now in Washington. I understand the administration's desire to bring more production home, but honestly, when I talk to a lot of US companies or foreign companies, if you want to come to the United States, the tax incentives are real. But then you got to start looking at the labor availability. You got to start looking at state and local regulations. You also have to look to the deregulation in general. And I'll give you an example, Dan. Right now, we're talking about increasing manufacturing production in the United States. That's fine. But right now we have 500,000 job openings in the manufacturing sector right now. We don't have the workers. Now you can use robotics and automation to offset that, but we'll see how that plays off. We also don't have the minerals and metals to build out these plants require copper, silver, graphite, you name it. So you've got an industrial boom ahead of us, allegedly. You've got the military build out, which is also a big source of demand for minerals and metals. And then you got the data centers. The data centers that hyperscalers are putting up all over the country. So there's a lot going on beneath the surface outside of Washington that could inhibit or slow down this manufacturing push that the Trump administration wants. And I'd also say, Dan, talking to a lot of European companies, yes, they want to come to the United States. They're already here. They might increase their capacity at certain plants. But given how the U.S. political cycle works, i.e., every 4 years, it could potentially be a new administration, they're feeling more whipsawed than ever before about one administration, then the next. What does it mean for the underlying policies? So, yes, there's a lot going on between the United States and Europe transatlantically beyond trade. The investment is a great story, but I'm a little kind of cautious on how much we're actually going to see change behavior of European and U.S. multinationals until we get some clarity around the trade. We had the court step in, but I do think that I don't think the court decision is going to slow down the administration's desire to have tariffs on certain countries, and the EU is front and center. So yet to be determined.
Dan, there he is.
Trying to find the toggle. It looks like we may have briefly lost Dan, so thanks everyone for your patience while I just try and identify where Dan exactly was. So we heard from Joe, we've heard from Courtney. Has Courtney reflected on tariffs and taxes yet?
I haven't, and hi Dan, welcome back. I'll let you
Brilliant.
resume control.
Thanks, Courtney. I think we got to the next part, Dan, which was I was going to invite Courtney just to talk about tariffs and taxes, but I might invite you to do that instead.
Great. Thank you, Barry, for stepping in there. Hopefully that my internet situation has stabilized. Courtney, was going to ask you from what you've your interactions with American corporates so far over the past 3 months of this administration. What are you hearing? What are you sensing in terms of how corporates are looking at this over the longer term on their strategies for foreign investment?
Well, Dan, it's probably an obvious statement, but the problem is less the policies themselves, which you can always adapt to and find a way around. It's the knee-jerk responses and the uncertainty. And, you know, as everyone can probably will agree with, Trump likes to put out really extreme policies and almost test them, and then he'll either pull them back or the courts step in, and that's creating a huge amount of uncertainty for companies. Obviously, the tariffs themselves are problematic and will make life incredibly difficult for U.S. companies, U.S. consumers, but also foreign companies investing in the U.S. But it's really hard to make long-term planning now when you don't even know whether the tariff policies will stick, whether there will be rollbacks. And it's really important to remember that greenfield foreign direct investment decisions, I think the point was made already, these are long-term decisions and they take a lot of planning. It does mean that they can be sticky in that you're not going to see companies just pulling out of the US because it's not that simple. But equally, you may want to hold off on building an enormous factory or something that's going to take you 5 years to bring to fruition when you don't even know what will happen next week. And I think the other thing I'd really like to highlight is there is what this means for U.S. companies. Anna laid out very well the various implications in the tax bill. But what really strikes me are these punitive measures and sort of retaliatory measures, which we see, of course, most notably with tariffs, but now we see that in the tax bill. And the estimates are that 80% of the current U.S. FDI stock comes from countries that would be impacted by this retaliatory tax policies. And this is really part of the Trump worldview, which is very zero-sum game. And it's all about who's taking advantage of whom and not the bigger picture. And of course, with companies, their global supply chains have benefited them enormously and created efficiencies. There have always been problems within that, but companies have benefited, consumers have benefited. As Joseph pointed out, we don't even necessarily have in the US the workforce to really adapt to these changes. And in fact, companies had created global supply chains in a way that actually made it efficient and helped these companies to succeed. And that's now being blocked and thwarted, both in terms of their ability to expand internationally, to structure their operations. But I think there's a really big risk in targeting foreign investment in the US. And we need to remember that the US is the largest outbound generator of FDI globally, but it's also the largest destination of FDI. And foreign headquartered companies account for hundreds of thousands of jobs in the US, and they're often better paid jobs than those created by domestic firms. So I think there's a real risk here, but the approach in the tax bill is very similar to the approach in the tariff and trade policy. And all of that creates a very worrying picture on the knee-jerk responses, the extreme nature of the policies and the uncertainty, but also this idea of going to bat and going to war with our trade partners, but also with countries that are our largest inward investors in the US, like the EU, most notably.
Thanks, Courtney. Mike, I was speaking to one of our members this morning who was making the very valid point that all of this will affect different industries to a very different degree. Clearly, there's a focus, as Joe mentioned, on repatriating in manufacturing production. As a veteran of the services, internationally traded services industry, what's your sense of how companies like your former employer and other companies in the services sector are reacting to this? And the administration clearly doesn't seem to be nearly as concerned about services trade as they are about goods trade. Thoughts?
Yeah, so I think Courtney makes a very good point in terms of, you made reference to the data center industry, for example. Those are an enormous CapEx investments that take years to come to fruition. And so we're not likely to see rapid changes across the industry. Indeed, when I'm talking to business leaders, I often focus when they're trying to explain what's happening in Washington and explain how to think about the approach to the new administration. I underscored you should focus on momentum and not moments. And if you even think about the last 48 hours, you can think about, if you try to make sense of the court decision, for example, and say what that means for my business strategy, whatever you think it is today, you'll be wrong tomorrow. So it's important to think about the momentum, not the moments. And for me, the momentum is clear, which has to do with a desire for greater economic sovereignty, for less interdependence, and more focus on the domestic audience in the United States. But I think just to go back to the title of our presentation today, our discussion today, it's about US multinationals, and the successful multinationals really are. And so in my own prior life, I was responsible for people across 33 countries in Europe, Middle East, and Africa. There was 25,000 staff in all those markets. Those are employees focused on that market, those customers, those governments. And so what I think you're going to see in the tech sector is a continued reminder that their success comes from being agile and culturally competent in the markets that they operate. So you'll see them continue to remind their local audiences of their economic value to the Irish market or the South African market or the Polish market, etc., in the same way as I think they will at headquarters be trying to be very mindful and thoughtful about the domestic stakeholders. So I think what you're going to see is more overt commitments to maybe new CapEx. The first question I think any major US-based multinational is going to ask itself is, if we're about to make a big CapEx investment, why wouldn't we, or why can't we do it first in the US? And then the question becomes, where else do we need it to be in terms of supporting customers? And I think Joe articulated really well, when you think about labor market shortages, when you think about technology shortages, when you think about just availability in the construction industry, which is an issue we know well in Ireland, same applies in the US. And so there is pretty significant medium-term challenges to quickly moving big CapEx investments from back to the US and then ignoring your customers in other parts of the world.
Yeah, Anna, maybe moving to you, given your focus with your firm on the tech sector, and Dublin's particularly Dublin, but Ireland's importance for the US tech sector. Are you hearing about any sort of changes of strategy by the American tech companies in Ireland, Europe, and also in terms of their concerns around retaliatory measures from the European side that could be focused on the tech sector, rather than, certainly it's my understanding that there's no question that the Europeans will not do a match the American sort of blanket tariffs, because it's simply not in our interest. But they may look at targeting American companies as a means of exerting pressure on the US. Any thoughts?
Yeah, a couple of thoughts. I loved Mike's comment there, momentum, not moments. And I think for all US investors here in Ireland or in Europe, and I think this equally applies across the globe at the moment, companies have slowed down the pace of decision making. So they've sort of held back and are holding firm and are assessing the options. So certainly the clients that I'm working with, they are trying to envisage the myriad of scenarios that could play out over the next period of time, and trying to assess the impact of those scenarios on their businesses, whether that is where they've made investments, their supply chain, where they have people, etc. So lots of companies are trying to imagine what those scenarios might be, and some are more exotic than they may have thought if they'd been planning scenarios 6 or 12 months ago. But I think lots of them are running the numbers on scenario planning. Lots of them are looking at their supply chain and whether it can or can't change in the short to medium term. But I think in common with many of them, they are holding firm on making any investment decisions. Certainly there have been decisions made by a number of international companies over the last couple of weeks and have been announced by the IDA here in Ireland. In addition, a number of the US tech companies have made announcements in the US. But one has to think that those were in the pipeline for a period of time. Investment decisions are not just made overnight. And so while we might be in a period where we won't see a huge number of investment decisions made at the moment, hopefully work is going on in the background that when we have a lot more certainty on where we're going to end up from a tax policy perspective, from a tariffs perspective, then business can get back to doing what business does best and make investment decisions that are suitable to their markets and where they want to do business. Your question there on the EU retaliatory measures. Obviously, tariffs are very focused on goods rather than services. We all know that the imbalance or the balance or imbalance between traded goods and traded services, while the Trump administration, it doesn't like the balance in favor of Europe, where goods are concerned, they fail to recognize that the balance of payments in relation to services probably goes the other way, where the US is a net beneficiary. I think the EU will think long and hard about any retaliatory measures that they introduce. And I certainly would, I think this shouldn't be an EU versus US discussion. This should be US versus the rest of the world. Obviously, the EU is the largest trading partner with the US, but I think the US will be, or the EU will be very slow to target large industries that employ lots of people across the European Union, where consumers within the European Union would be adversely affected. But I think the EU will have to be a bit braver, probably, than they may have been over the last period of time. But I certainly would not like to see measures that target industries that are large employers across the European Union, and particularly the IT or the tech sector. I don't think that's in anybody's interest. So, obviously it remains to be seen how the EU react, but I think they will react in a measured way on advisement. And certainly they're taking input from all of the European Union members on that.
Thanks, Joe. Let me first of all recommend to people Joe Quinlan, Daniel Hamilton's annual report on the transatlantic economy is certainly something I've been reading for many, many years, and is a go-to publication for the facts and figures on the relationship. But Joe, I'm trying to look at maybe some positives coming out of all of this, and wondering that, as you and Dan always make the point in the report, that US multinationals earn a lot more of their total global revenue from their foreign subsidiaries than they do from sales from the US to foreign markets. I'm wondering that in this world that maybe is moving into what people have called blockalization to replace globalization, that American companies would actually increase their investment in other countries in Europe to just avoid the whole tariff thing. Do you see that as a possibility, that they actually ramp up their FDI so they do less trade and they do more servicing of foreign markets via their foreign subsidiaries?
I mean, Dan, in a perfect world, they'd like to, but remember, foreign direct investment pulls trade, or they're complements, not substitutes. But to your point, Dan, we've talked to a lot of companies in Europe and the United States, and there's less talk about reshoring, U.S. companies coming back. It's more about friendshoring. So, let's find some countries that are beneath the radar screen of the Trump administration's tariffs, whether it's Vietnam, Mexico, and of course, Ireland. Because I think Mike said it well, multinationals are just that, multinationals, right? And a lot of, the administration knows business has got to educate them more that in order to grow earnings, you need the consumers overseas, you need the resources overseas, and the labor, whether it's R&D, whether it's natural resources, and the consumption power. So I do think that more of that friendshoring is a key element versus reshoring, and Ireland would fit right into that kind of scenario whereby, yes, we'll bring some production back, maybe pharmaceutical ingredients, semiconductors, but that's basically it. And there's really, it's remarkable, Dan, and we keep talking about bringing production home, the manufacturing renaissance. we haven't opened a new refinery in the United States in decades. So I know lots of projects that are ready to go, uranium, for instance, in Wyoming, but to get the permits, get the process going, you're talking 2035, one company told us the other day, which is just too far out there. So there's got to be a reality check. And you know, multinational CEOs, they live in reality, not in the policy arena. And the reality is they need these overseas markets now, next quarter, next year, next decade. So I think there'll be a lot of moving parts, but at the end of the day, there's not going to be these big shifts. If it's a tripolar world, sure. You want to be in North America, you want to be in Europe, and you have to be in Asia, China included. That's how the world is kind of taking shape here.
Courtney, as Joe mentioned there, staying under the radar. Is that something you're noticing companies wanting to try and do and just get on with their business and just try and stay out of the limelight? And just in particular, we saw in recent days with the announcement last week of 50% tariffs on Europe, and then that was changed in terms of time. But also with that announcement from the US administration was a particular focus on one company, Apple. Is the mentioning by the US president and the administration of companies, is that something that is that a way that they can influence investment decisions and try and get American companies to invest less abroad, possibly even reshore? Is that something that sort of bully pulpit going to be a factor in the broader scheme of things?
Well, to answer your first question, yes, I think keeping your head down, there's something to be said for that, both for companies and for other countries. And as Joseph mentioned, I think the friendshoring has been a clear trend for the past few years, and I also would expect this to accelerate. And there are certain countries that got off lightly on the tariffs. Colombia, for example, a friend of the US, got away with 10% tariff rate. And so you could companies could be considering places like that Trump had a brief spat with the Colombian president, but died down very quickly. So countries like that, where they are a little bit off the radar, will be beneficial as destinations. But likewise, companies themselves, I mean, it's kind of a bully pulpit in the true sense of the word, which is a bullying companies and making examples of companies to sort of bully others a bit into submission. And yes, I mean, sticks can have their impact, but carrots tend to work better when you think about actual incentives to incentivize companies and to correct flaws in the investment environment are actually much more effective and powerful as a means of driving foreign direct investment, keeping it home, but also attracting it to the US. And you see that companies, because Trump reacts in very personal ways, that does leave corporate leaders with some dilemmas. Do you flatter? Do you cozy up? Or do you just try to stay out of the crossfires? Or do you fight for your company, your industry? Do you speak out against policies that you view as detrimental to your company, to your workforce, to your industry, and then risk being the next, company in the crosshairs? I think this overly kind of personalized nature is adding even more to the uncertainty in terms of the environment that corporate leaders have to navigate now.
Mike, sort of similar question to you in terms of the influence of picking out bigger companies. You used to work for one of the biggest. Is that something that companies worry about? And also coming back to the issue for US businesses operating in Europe, do you sense trepidation about what could happen? Relations between Brussels and many of the US tech companies haven't been, great to put it mildly, and they're getting caught up in this whole thing. And the US president has certainly been threatening Europe with the use of competition policy against the US tech companies. How do you see all of that playing out for the presence of US tech companies, services companies in Europe?
Yeah, to Courtney's point, Dan, I think there's a certain damned if you do, damned if you don't in terms of how you play things in the short run. And I think companies, even as the months tick through this year, I think companies are getting a little more nuanced about how much they put their head above the parapet and how and when. For example, my old company was part of that big trade mission to the Middle East in the last couple of weeks, and was clearly there to support that kind of outreach to Saudi Arabia, Dubai, etc. So you get some credit for that. Tim Cook didn't go, and so you can read that in any way you like. And there's, again, that's a moment in time decision, and you get a reaction very publicly because of that, but that doesn't necessarily mean it means anything in the long run. I think to your second point, though, Dan, in terms of, how are US multinationals thinking about their brand, their storytelling, their employee proposition outside of the US, especially in countries across Europe, I think this is there's a lot to still play through here. And so, I'll give the example, my prior life, I had responsibility for the human resources function. And so what you saw very quickly and very loudly, some very prominent US companies across all sectors saying that they were modifying their commitments to diversity, inclusion, and equity, and backing away from their DEI statements or modifying them to take away certain keywords or buzzwords or woke words, depending on how you where you sit on that perspective. That may make sense in the short run in the US, and but at the same token, the question about the employee proposition and the connection between an employee and their value set and their employer is still really important. And across Europe, issues around worker support, flexibility, balance between work and life, and parenting, etc., is still highly valued, and both by employees and frankly by governments. And so you've seen in the last several months, sweeping statements, or even just the simply removing of statements from corporate websites in the US, and then country leaders, even in prominent country heads for some of the multinationals in Ireland, having to kind of thread the needle really carefully as to what does that mean in terms of their commitment to the employee proposition and employee care. And so I think you're going to see, again, if you play for the longer game here, American multinationals having to think really hard about what their brand proposition is, and make sure that they own the narrative about their brand, as opposed to a statement that's made from the Rose Garden about their brand, so that they are controlling the story, both for current and future employees, but probably just equally as important for the governments in the markets where they operate.
And Mike, just to follow up on that in terms of the American branding of companies, we saw in Canada that a lot of American goods were taken off the shelves. There was a sort of very strong reaction to the tariffs in Canada. We've seen Tesla cars collapse here in Europe, sales this year. Do you see American companies lowering their sort of American branding as something, as a trend, a phenomenon coming out of this? And is consumer boycotts, do you think consumer boycotts will play any sort of role? And then a question to throw out to all of you. Multinational companies buy and sell subsidiaries all the time. Do you see one aspect of possible deglobalization coming in the form of American companies selling off, spinning off their foreign subsidiaries, taking the money, repatriating the capital, investing into the US, or giving it back to shareholders? So that's one I'd be interested to get all of your views on. But Mike, specifically, the consumer boycott issue, the American branding of companies, is that sort of a short-term thing, or do you see that having a lasting effect?
I think that it operates on two levels, Dan. I think in a couple of the companies you mentioned, so you had a very clear alignment, a visible connection between the Trump White House and their company leadership. So if you think about the Elon Musk factor for Tesla, for example, I think that kind of puts it out a little further into people's minds in terms of the consequences of their buying decisions. I also think that those kinds of things work, boycotts or reactions to a particular brand work well when there's lots of choices in that consumer market. So one of the things I think that Europe, for example, is thinking hard about, and I don't think has landed on a solution, is because of the success of would say the cloud providers in my old world, whether it's Google, Amazon, Microsoft, etc., or the pharmaceutical world, what you see is a real concentration of innovation and capacity in the market owned by US brands. So it's very hard to suddenly say we're going to spin up a European Facebook or a European WhatsApp because we want to boycott an American one. So I think what you'll see from a brand perspective is those companies, they will be very mindful of reminding people about how many local businesses operate on their platform, how many national governments leverage their technology, the services they provide for the citizens of that individual country, and maybe say a little bit less about their US roots.
Thanks. Thanks, Mike.
Dan,
Joe, jump in.
Well, we to Mike's point, we heard a lot of that from the European company, U.S. affiliates in Europe and Brussels in March. They said exactly what Mike was just talking about, keeping a low profile, really talking about how localized they are, how much they help the community, they're partners, not competitors. This too shall pass. So that's right up Mike's alley, what he's talking about in that sense. And, brand nationalism has picked up Canada, other parts of the world, but I think it'll fade. I mean, it comes back to the product, and companies are going to manage that through. But to Mike's point, the U.S. affiliates recognize they're under the glare politically, but they're working hard to kind of offset that by being more local partners and really talking about that.
Okay, Joe, so I'm going to ask you specifically on pharma. Pharma companies, again, they acquire, they sell off parts of their businesses all the time. Particularly of concern in Ireland, given the scale of the pharmaceutical industry, or how much American pharmaceutical companies make here for the American market. Do you see the possibility in that industry, or more widely in other sectors? Mike has said it's difficult to see spinning off of Facebook, but do you see in the pharma sector or any of the manufacturing sectors, American companies selling off their foreign subsidiaries as a way of deglobalizing and
The short answer, Dan, no. And I'll give you a good example. We've got a great client. He's a friend of mine. He's a CEO of pharmaceutical ingredients, makes a lot of product in China. He worked 4 years with the Biden administration, trying to get the incentives through the IRA, the CHIPS Act, everything. After 4 years, he said, forget it. It's easier to build in China than to go through all the permitting process in the US. And they just folded the tent and went home. So US companies are smart, right? It's good to make products in the US. But if it's easier in Ireland or Poland or China or any place else, Israel, that's where they'll do it.
Anna, would you have any concerns about that, the possibility of deglobalizing via selling off foreign subsidiaries? You hearing that?
No, I am not hearing it, and I really don't think it's going to happen. I'd be very, very surprised. Selling your international business for, maybe you get a good price day one, but reinvesting it back in the US in a market that is maybe a constrained market at the moment. I mean, multinationals talk with their feet. They move into different markets because there are consumers there buying their products and services, or they can access talent. So I certainly think they're going to continue to need talent. They're going to continue to want to have customers to sell their products and services to. So I don't think a sell-off and retreat into a bunker in the US and try to deploy that capital in the same way is going to happen. Certainly that would be my bet anyway.
Okay, thanks. Courtney, but broadly, same question for you. Are you hearing anything around that? And, companies looking at whether it's selling off their foreign subsidiaries, you hearing companies thinking about how to reduce their foreign footprint and go home?
Well, they're definitely having to reassess their strategies and figure out what makes sense in the new environment. But I think it was mentioned earlier about just how lucrative foreign subsidiaries tend to be, and what a profit driver they are. So in that sense, it may not always make sense. I think the more likely scenario, which we often see in times of uncertainty, is hedging. So you'll often see more FDI projects, but smaller. We saw a very similar pattern related to investment in the UK post-Brexit. So you're not going to wholesale give up on the UK, but then you need to start hedging and you need to have more presence in Ireland, in Germany, France, and elsewhere. And I would think the smart bet for US multinationals is to hedge. So you definitely, at this political moment, don't want to be seen to be pulling out or reducing your size in the US and laying off US workers. Those are not good optics. But equally, you cannot go all in on the U.S. That especially when the U.S. is now quite an uncertain, in many ways unstable environment. That also wouldn't make sense. So I would expect the hedging, looking at the friendshoring locations like Joseph mentioned, and just trying to see what makes sense to sort of allocate risk a bit differently.
Great. Thank you all. Sorry for taking a little bit more of your time than we promised. I think it was a great conversation. Leaves me a little bit more optimistic at this current juncture. So thanks again for your time. It was great to have you all.
Thank you so much.
Thank
Thanks,
you.
Dan.
Have a good
Take
rest.
care.